Hi, I'm Steve Esnoff from Resolute Private Wealth and welcome to our February update. Today I'm going to talk to you about markets, the Royal Commission and also franking credits. Starting with markets, February's been another good month for share markets, and since the start of the year our share market is up about 14%, which has gone largely unnoticed, I think, particularly off the back of the really negative end to late last year where we saw share markets fall about 16%. So with that in mind, we're roughly 3% off our August 2018 highs. So there's been quite a dramatic change of direction for share markets over the last 2 months, and I just wanted to explain some of the reasons for that, I believe. Firstly, I think market sentiment has changed, and an example of that would be the US and China and their trade deal looking more and more likely to take place. Interest rates have also played a large part in the market turnaround, particularly in the US, where late last year it was thought that the US Fed would continue to raise rates throughout the course of this year, where it's looking like that's going to be less and less likely. And in fact, locally, the Reserve Bank is becoming under more and more pressure to cut interest rates here, which will hopefully reduce expenses for households and allow for further spending and further growth of our economy. In addition to those factors, the Australian share market is going through its reporting season. So it's a period of time where Australian companies, release their profit for the last 6 months and provide future guidance on what their expectations look like going forward. And entering into this period, it was looking like it was going to be quite a negative reporting period. However, it hasn't been the case. And in fact, of the companies that have reported, more than 50% have beat expectations, which has been really pleasing. So what does all this mean? Well, I think it means the share market has and will always be volatile. It's really important that you keep in mind your investment time frame, block out the noise. The media does like to promote the bad news of the market, but they don't necessarily promote the good news. And really stick to your investment plan. And if you have any questions and queries, please direct them towards me and we can work through what those concerns are and whether you're taking too much risk or not taking enough risk with your investments. Over the last 6 months, we've had a Royal Commission into the banking, super and financial services industry. And on the 4th of February, we had the recommendations of the Commission handed down. There were 76 in total. Prior to the recommendations being released, the Royal Commission did have a pretty profound effect on the industry, and it did promote some change pre-recommendations. Some of the changes that were put in place, for example, were banks tightening their lending policies. The Commission did affect businesses such as AMP and NAB. AMP really had its business model questioned, and I'd argue that in its current form, it's probably not sustainable. And NAB lost its CEO. So with the recommendations being released, my thoughts were that they were probably a little bit soft and a little bit lenient. I was expecting something a little bit more dramatic and hard-hitting, but that wasn't the case. And I think the market was also expecting something along those lines. And we saw the bank share prices all leap about 8% the day after the recommendations were released. So of the recommendations, my general takeaway was that we do have an appropriate legislative framework in place, just big and small business wasn't following the rules, and the rules weren't being enforced by the regulators such as APRA and ASIC. So I'm expecting both regulators to be a lot more proactive in the space. Another key recommendation was that trailing commissions are to be abolished, which I think is fantastic. Trailing commissions still exist on old investment, super and insurance products, even current insurance products, and also on mortgages. Mortgage brokers receive commissions on home loans that they firstly establish, and then they also receive a trailing commission for the life of the loan. Now, mortgage broking was one of the hardest hit segments of the market with the recommendations, and that profession is really in a state of unknown at the moment in terms of what that space is going to look like going forward. Now, both sides of government have said that they're going to implement the recommendations handed down, all but the ones around mortgage broking, which is still yet to be worked through. So I think the Royal Commission was good. I think at the end of the day, consumers are going to be better protected. You're going to have more transparency and hopefully better advice across all aspects of the financial industry. Finally, I'd like to talk to you about franking credits or imputation credits. These relate to Australian companies, and there's been a heightened awareness around franking credits given the Labor Party's policy with respect to the refund of franking credits. So quite simply, if you're an Australian company and you make a profit, you'll pay tax on that profit on behalf of your shareholders, and you'll pay tax at say 30%. Now you as a shareholder are entitled to receive part of those profits, which you'll receive in the form of a dividend. That dividend will be paid to you, and you would have already paid tax on that dividend at the company tax rate of 30%. Now, for example, if your marginal tax rate is at 40% and you've already paid tax at 30%, then you'll just have to pay the difference in tax. Conversely, if your tax rate is at 15% and you've already paid tax at 30% on your dividend, then clearly you've overpaid in terms of tax, and in your tax return there'll be an adjustment and you'll get a refund of that franking credit. So quite simply, what the Labor Party is looking to introduce is in the situations where there is a refund of franking credits and you don't pay tax, they're looking to put that to an end, which is clearly not favourable from an investor's point of view, whether you own shares personally or whether you own shares through super or through a pension scheme. But that's sort of the lay of the land at the moment. Hopefully that helps, and that's all we have time for this month, but we'll be back again next month with more.